Bitcoin for 3 years and your max return is 45%. Like, why would you do that? Like, that doesn't, to your point,
Exactly.
you're not putting in Bitcoin to be your stable, give me 8% a year type thing. Like, you're putting your money in Bitcoin for this thing to triple in 3 years or potentially be down 80%, right? Like,
That's the whole point. Yeah. Hello, everyone. My name is Shana Orczyk Sissel, and I am the founder and CEO of Banríon Capital Management. This is What's the Alternative podcast, where we get into the weeds of alternative investing with the leading experts in the space. Today, we have Vinay Tolia with us. Vinay is the CEO of Marine Lair Advisors. He grew up in Michigan and entered finance directly out of college. His first internship was on the trading floor of the CBOE, and later he co-founded a derivatives trading hedge fund with his twin brother, which ran for almost 20 years. After a brief stint taking a company public in Canada, Vinay is back in finance, realizing that RIAs do not have the institutional derivatives trading knowledge needed to best trade structured notes. He co-founded Marine Lair with his brother Sanjay. They now operate as a derivatives trading desk for independent RIAs, taking the guesswork and administrative hassles out of structured notes. I think this is a pretty timely conversation to be had, as structured notes and buffer funds and all of these, known outcome or
defined outcome.
there you go. Defined outcome vehicles are quite popular, and more are coming out. The latest trend in defined outcome is with crypto. Vinay and I have talked a lot about this. We both have very strong opinions, and I think anyone who's seen me speak on TV knows that I have been very, very vocal about my disdain for some of these products. And it's not the product itself that's the issue. It's oftentimes the marketing and the pushing of product that fits the niche, but maybe isn't the best product for the niche. There is a time and a place for structured product. There is a time and a place for these defined outcome vehicles. But the way that the industry has kind of exploded in the space is concerning. So I thought it would be great to have Vinay on with us because he shares some of my thoughts here, and we can dive deep into structured notes. But I think a good place to start for our audience, Vinay, is to kind of talk about A, what is a structured note? B,
Yeah.
how does that connect with buffer funds? Because I talk about them interchangeably for a reason. And then sort of what you've learned through your years as a derivatives trader on how these things have been traditionally structured and sort of, the pros and cons.
Yeah. Well, first, thanks for having me, Shana. I'm excited to speak with you and get deep into all this stuff. And it's always nice to have someone who is kind of a derivatives nerd like myself. Uh, so there. Let me just back up. So I traded derivatives, listed derivatives for years, and I heard all the things about structured notes that most people hear. That hey, they're super high fee products, they're rip-offs, and all the negative things that you hear, that it's just a bunch of BS that the bank is trying to shove onto retail. And that was my kind of a very uneducated opinion on the space for years. Where what really kind of flipped the switch for me is I didn't realize how much more efficient these things have gotten over the last 5 or 6 years with the advent of a lot of the platforms that allow for greater distribution and for allow auctions to take place. And what I mean by auction is, for the longest time, if you were these things were only available to people who were clients of the large private banks, and they could only deal with that bank's trading desk. So if you were a JP Morgan customer, you got access to JP Morgan structured notes, and that's it. Now you can run an auction, and so you can get a note from any bank, whether it be JP Morgan, Morgan Stanley, or you name it, and that has caused this kind of industry to get much more efficient. This is like, it reminds me of being back in the trading floors when it was an actual floor and we were trading in fractions. And now they're still kind of archaic, but they're moving more towards the more efficient markets of today. So that was kind of how I well, the big unlock for me was I realized that okay, these things have gotten more efficient, and I realized, hey, I should be doing this myself in my own personal account. And I took that realization, started talking to some RIAs, and realized that the way they were looking at these products was not from a derivatives first approach. And to answer your other question, what is the structured note? The structured note is kind of a pre-packaged bond and derivative. So it gives you use the term defined outcome, which I like, because you invest in a product. It's essentially a corporate bond, and at the end of at the maturity date for the particular note, there is a return based on like you know specific levels of an index or some kind of underlying. That's why they call it defined outcome. You know that if the S&P is above this or below this, you know exactly what you're going to get. And the way these things are created is with derivatives. And so the best way to understand if you're getting something that makes sense for your client or is pricing well is to understand derivatives. But the vast majority of people who uh, trade these things and who sell these things do not understand derivatives. So they end up giving advisors a lot of things that don't make a lot of sense for the clients, which I'm happy to get into. But I know I'm droning on, so I'll stop right there.
No, I think that's a really good point. When I started seeing structured notes out in the marketplace, it was 2007, 2008. It was, as you said, coming from the big investment banks. It was broadly available, so I didn't have to be a JP Morgan or a UBS client to gain access to them. They were distributing them broadly speaking because I was working for an independent RIA at the time. But the one thing that always struck me was that I was captive to whoever the issuer was. So if UBS was the issuer of the note and I needed liquidity, which at that time a lot of people were, panicking and wanting to sell out of things, I had
Yeah.
to go back to UBS, and UBS had all the power in the world to give me, as a distressed seller, not the best pricing, and I had no choice but to accept it if I wanted liquidity because that was my only option.
Mhm.
The other thing is exactly what you were talking about. I don't know that people fully understand or appreciate that at its core, and I'm probably oversimplifying this a little bit, a structured note is simply a zero coupon bond paired with a derivative contract of some time, a call option, a put option, a combination of those two things. But that's what it is. They have stated expiration dates and stated maturity dates, and they're also an option contract that when they are in the money and they are executed, that's it. There's no second bite at the apple. And so I think a lot of folks don't fully appreciate that aspect. I do think it's a little easier to understand and swallow in the structured note aspect when it's packaged as a structured note. But I think in the buffer ETF wrapper, it's not as well understood. It's not fully appreciated that this is a, buy at the issuance, sell out of it at the maturity, or actually you just get exercised out of it at the maturity. It just ends. And then everything in between is kind of the wild, wild west. And if you get in at any point in between, you're not actually guaranteed the defined outcome. But more importantly, if you don't understand that this is an option contract, a derivative with a zero, you don't understand that it's a single round trip. So a lot of the crypto buffer stuff that's coming out, and crypto being as volatile as it is,
Yep.
concerns me, because if you're getting downside protection of like zero downside or zero or 20% cap on downside, crypto can and has had more than a 20% round trip in a 1 year period of time. It's the first 20% that you're protected on. After that, it's either these buffer funds aren't like structured notes where you're just exercised out of it and you're done. The buffer products continue till their stated expiration date, but the products underneath it don't exist anymore. It's just really the zero coupon at that point. And you don't have the protection of the downside anymore. It was a single trip because they can't rebuy option contracts in the way that these buffer funds are built.
Are you speaking of buffer funds or the buffer or the ETFs?
Well, I mean, the ETFs are the funds. There's
Yeah,
not
got it.
like
Yeah.
buffer
So
mutual
they
funds.
just automatically roll after.
Yes.
Yeah.
They do, but,
Yeah.
unlike a traditional structured note where once the event happens, the note's, matured,
Hmm.
and you move on,
Hmm.
the buffer ETFs don't work that way, and I don't know that everybody is fully aware of that. So we can dive into that a little bit, but let's talk a little bit about, a lot of advisors love these products because they are defined outcomes, and for risk, averse clients, being able to give them, exposure with training wheels or exposure with like a parachute to areas of the market that they might not have the stomach to take the risk of
Hmm.
seems like a good idea, and in some cases it can be. But let's talk a little bit about like the broad availability of structured notes versus what you guys are doing, which is creating custom notes, based on individuals needs, and kind of how those two things are different, and the pros and cons of each.
Sure. So just let me take my glasses off. I can see the reflection here. The you did not oversimplify it. You hit it right on its head. That's exactly what a structured note is. It's a zero coupon bond and some kind of package of derivatives. And the zero coupon bond is easy to understand. Everyone gets a zero coupon bond. Um, but the derivatives are harder to understand and they're harder to value. So like to figure out what makes sense and what doesn't, you have to understand the derivatives.
So let's talk about a little bit about, the broad availability of structured notes, as in,
Yeah,
the issuance that are coming out. You talk about marketplaces, or a UBS or
oh,
one of the big investment banks issuing like broadly to the market a
got
structured
it.
note versus kind of what you're doing, and there are other
Oh, oh, oh.
platforms that do it,
Yeah,
and
yeah,
and
yeah.
kind of the pros and cons of each.
Yeah. So, uh, a couple things. What one is one of the reasons these things have been gaining in popularity and um, is it is, as you very well know, uh, advisors are always, especially these days, trying to differentiate, right?
Mhm.
Like clients are asking, "Hey, what am I paying you 100 bips for if you're just running a robo portfolio for me?" Structured notes are one of the things that they still can't do themselves. So like they have to go through an advisor. There's a handful of these things, not the only thing, but that's that has been a reason why, if you want to get people uncorrelated differentiated returns, they have to go through an advisor to use these. Now, I think what you're referring to is the difference between calendar offerings and custom offerings. So
Mhm.
every month, the big banks will issue just
I just
a.
want to
Oh
let
no,
our audience know
you
my cat decided to make an appearance, and
I think my dog is
she
pawing
never
at the door
does.
over there. So if you hear any whining, that's what's going on. Uh, so cute. The it's okay.
As you
So
were saying, calendar offerings and
yes,
custom
yes, yes, yes. So
offerings.
so every month, the all the big issuers, UBS, JP Morgan, you name it, they issue a bunch. They issue like a whole array of notes that are open for the entire month. So they give
Mhm.
you a price of a note, and it's open for the entire month, and advisors can put in any amount they want. They can put in as little as $5,000, and or they can do as much as they want. Now the problem is, if you just take a step back and think about this, if you were a trader and I was asking you to make a price for a product that you have to honor for a whole month, you're not going to make me a great price. And understandably, because you don't know what's going to happen over the next month.
Mhm.
So these calendar offerings are they're not the best price. They're a very wide kind of bid ask spread. Um, and so for what we do is we kind of work with our clients and figure out, first of all, what is the right structure, what are the right underlyings, how much protection do you need, all that stuff. And then we trade a custom note. So we trade a note that will trade in a couple days to a week from when we talk to the bank. And what that does is it gets you a much better price. So a big part of I mean, this is low hanging fruit that everyone knows, but a big part of structured note users are just moving from calendar offerings to custom offerings,
Mhm.
and you get much better pricing just by doing that because you're getting something bespoke to you and not something that the bank is holding open for a prolonged period of time.
So let's talk a little bit about how buffer funds are often associated and mixed in with this conversation,
Mhm.
and why they're similar, but also why they're different.
So, buffer ETFs have absolutely exploded, as everyone knows, and I believe that the one of the main reasons for that is just the simplicity of it. It's like a lot of these guys that I know that use them, they know that it's not the optimal thing. If you, especially if you're buying and holding, if you want to, park cash somewhere for a little bit, I understand why you use a buffer ETF. If you're talking about holding something for a handful of years, which I've seen multiple people do, it you know it's a high fee product. You have that upside cap, which as we know, markets don't just on average they might they go up 8, 9, 10% on average, but that's not how they actually move. Like you got a 5% up 30 and then a flat, right? And so uh, when you have the big market rips, if you're capped at 11, 10, 12%, you're not getting all that juice. Where if you're going to put it into, if you were to take that money and put it into a structured note that matures in 3, 4, 5 years, you have uncapped upside. So buffer ETFs, there's a time and a place for them. I'm not here to knock them. I think they're they're great products. It's just that I have found that lots of people use them simply because of the ease and the fact that it's an ETF, so they can plug it into their existing portfolio management software, whereas structured notes are a little more cumbersome to administer, and that's actually one of the things that we try to solve.
So yes, I have been much more um, vocal about my disdain for buffer funds, but some of the reasons why I dislike buffer funds are for some of the things that you discussed. I don't think they're used properly. I don't think they're used optimally, and I do think that they're not communicated to the client properly. And for all of those reasons, I'm not the biggest fan. I also don't like some of the newer products that are coming out, which are doing buffers on products that the whole advantage of those products are the volatility and the asymmetrical return profile. And when you remove that, which is what you do in these buffer products, it there's no purpose.
I
Um, and,
I saw one yesterday. Sorry to interrupt. I saw one yesterday on Bitcoin on on IBIT, the ETF, and
mhm,
it was a 3-year thing. This is a structured note. Okay, so this is not
mhm,
buffer ETF, but it was like 20% buffer, but it had 200% leverage to the upside, but
mhm.
it had a max return of 45%, and I'm thinking like
Over three
you own
years,
Bitcoin for 3 years and your max return is 45%. Like, why would you do that? Like that doesn't, to your point, the
exactly.
whole, you're not putting in Bitcoin to be your stable, give me 8% a year type thing. It's like you're putting your money in Bitcoin for this thing to triple in 3 years or potentially be down 80%, right? Like that's
That's the whole point. Yeah, there's
yeah.
the latest trend, and most of the new offerings in the buffer space have been crypto related, either attached to Bitcoin or ETH.
Mhm.
And I am in full agreement with you. The first ones were like 0% downside, but like an upside cap of like 10%, which is ridiculous. Now they've done what you're talking about, which is having a little bit of a longer period of time, but like your upside's capped at 20 or 30%, and your downside is capped at like 20. And my whole point is exactly what you just said. The reason you own Bitcoin is because of the asymmetrical return opportunity.
Yeah.
And also the knowledge and understanding that, it's volatile and you could be down 80% as much as you could be up 1,000%. But that has diversification benefits in a portfolio, and so you want that. That's a feature, not a bug. And so when you remove that, it feels a little bit disingenuous to have these products because the folks that are buying them would never really own Bitcoin because they're
I,
risk averse. So
I
they're
completely
buying
agree.
them to
Yeah.
say they own Bitcoin, but it's
I,
not really Bitcoin exposure.
I totally agree. Imagine having a venture capital portfolio where you cap your winners at 45% over 3 years. Like that's insane.
Mhm.
The whole point of that business is to have, you know, 2 out of 100 that are 1,000x. So yeah, I completely agree with you that that doesn't make a whole lot of sense.
Yeah, so now that we've established that some of these products, I like to say, because I'm not afraid to make waves, they're just well packaged marketing stories, and they
Mhm.
just don't make sense in my head. Some people are more aggressive about it. Cliff Asness has written many a white paper on his disdain for these buffer products, but ultimately, at the end of the day, a buffer ETF is a structured note in an ETF form, and you have to understand that, look through the prospectus, understand what the underlying are, how it's being priced, but also understand that the ETF's pricing and all the price movement between the issuance and the expiration of that buffer before it rolls is going to be market movements, and whatever the underlying is doing is going to be reflected in the price of the product and not necessarily the defined outcome that you purchased it for. And so
Yep.
that's a conversation you need to be able to have when your client sees their statement. It's a little bit different in the structured note format. And why don't you talk about operationally kind of how it works? Because you did note that one of the reasons that you think buffer funds have been so popular is because they're not as operationally cumbersome. When an advisor is considering these defined outcome products, what should they be considering? And I've always found that it's never that the operational issues are so cumbersome that you can't get over them. It's just if you don't know they're coming and you're not prepared for them, they can immediately stop you from proceeding and then deciding to do the path of least resistance. But if you tell them ahead of time, look, this is what's involved, they can be prepared for it and work through it. So I think that that's a good opportunity to do just that.
Yeah. So the great question. So one of the things that we see is that the we're talking about the most simple kind of form of structured notes was just a single index, and if it goes up, it's capped at a certain point. If it goes down, you're exposed to losses after a certain point. These things get much more like you can do anything you want with these things, and that's really good. And it's also really scary for a lot of people. Like most people don't want to, and they all have different names: Phoenix Auto Call and Catapult and Shark Fin. And people start seeing all these things and they just say, I don't want any part of this. Let me just go on to whatever I was doing before. um but like, so a lot of people are scared away by the complexity, and I totally understand. Um the that typically a way an advisor allocates a portfolio of equities is by using a portfolio management software, and those things all look at listed equities, and you can plug in any of those things into your portfolio management software. Now, I don't know how good they model buffer ETFs, but it is a listed equity, so you can put it in there, and it'll feed through and look at all your you know analyze it in context with all your other equities. Now, a
Well, it
structured
is
note,
difficult to do buffer ETFs because they typically have no history and they
they,
typically don't have more than a year's worth of performance. And then they're just done. And so putting them in any kind of analysis becomes exceedingly difficult. But in statements, that's a different story. And so that's kind of, the thought process. But if you were going to model out something like this and you knew what the underlying was, which I would assume would be the case in some of the structured products that you talk about, then it's a little easier to model it because whatever the underlying is of your structured note is usually a publicly traded instrument or an instrument in which you can easily model it out with some other proxy, correct?
For sure, for sure. That gets a little more complicated than that when you have multiple underliers on a particular note, because you don't know exactly what you have exposure to until later on in the duration of the note. But the big difference when it comes to administrative stuff is with the listed equity. If however you wanted to rejigger your clients' portfolios, like if you wanted to, I'm making this up. If you wanted to sell everyone's Tesla and replace it with a buffer ETF, you could do that with a couple clicks. with a portfolio management tool. You can't do that with a structured note because these things are essentially corporate bonds.
Mhm.
So you can't just point and click and trade it the way you trade in equity. And so what we find is a lot of people really like these things, and they start putting them in client accounts, and they start allocating kind of sleeves of their client portfolios in these things. But then what ends up happening is you have new money coming in and out, and you have all these different notes that you're trading every single month or quarter, however often you have them, and you can't just point and click and rejigger them the way you can with listed equities. And so you need some help. And what a lot of people, what ends up happening is you end up with these unruly spreadsheets, and you have a junior person whose job is like 80% of their job is basically managing this spreadsheet. And you might say, like, this sounds insane, and yes it is, but like these people love the features of the structured notes so much that it makes sense for them to have a junior person do nothing but rejiggering spreadsheets all the time. And that's where we come in. We have software that analyzes across customer accounts exactly how the customer wants it, so that to get you out of these spreadsheets, and however often you want to rebalance your portfolio, monthly, quarterly, whatever, we just have clean reports for you, to kind of try to, we call it QSIP sprawl, because each one of these things has a different QSIP, and before you know it, you have hundreds of QSIPs in your client accounts, and it gets really really hard to track, if
So
that makes sense. Yeah.
So what prevents a firm like yours, and maybe you already do this, or maybe this is in your future, of
Yep.
approaching structured product the way that a lot of folks approach like municipal bond laddering, or you get these SMAs where they're doing laddered investment grade bonds. You see it a lot where you can just
Yep.
buy the SMA, they build out the ladder for you, and then they just manage the trading for you, and you're just making allocations into the SMA.
Mhm.
Is that something that you think is in the future for the structured note industry?
We are, yeah. So that we're actually in the process of rolling that out right now.
Okay.
We're in the process of rolling out. That's absolutely one of the solutions. But there's a lot of advisors who don't like using SMAs, right? There's a lot of advisors who say, "Hey, the client's paying me for my, like, I consider myself kind of a PM, and the client's paying me for my advice, so I don't want to outsource that, have another layer of fees, so that's why I'm doing this myself." So what we try to do is, for those folks who want to do it themselves, is to take away that administrative hassle. That's like a big part of what we try to do.
Well, I will say to those advisors that feel that way, institutions outsource this stuff for a reason. Your job as a portfolio manager and an advisor is to, make the right decisions for yourself and your clients, and not spend more money. And I also like to point out the potential for error in the managing it yourself when it's this kind of complexity and
Mhm.
this kind of approach is significant. And it's like anything, paying somebody who can do it better. That is actually the value you're bringing, because your client can't get access to these A without you, but B, they can't get access to the people that you are outsourcing to without you either. And so
Mhm.
you're actually earning your fee, and probably more so than the potential for trying to do it yourself and screwing it up. But I'll get off my high horse on that one, because I feel like sometimes advisors are so concerned about earning their fee, they forget that earning their fee means also making smart allocation decisions and keeping themselves out of the crosshairs of the regulators. You want your business to continue, and you want happy clients, and the more you try to take on yourself when you're not the expert, the more likely you are to end up in hot water. So talk a little bit about how you go about doing what you do. We've talked about how most folks are doing the calendar offerings. They're seeing what
Yeah.
UBS or JP Morgan is. But there are platforms like yours that exist that can assist in finding these custom product offerings, sitting down with the client. Again, if we're going to get to like earning your fee,
Mhm.
this is a customized solution. You're sitting down with the advisor and their client, and you're figuring out, what the defined outcome is that the client needs, what the client's risk tolerance is, and how to properly put that together in a product that makes sense. And then also, you've pointed out several times already, the duration of these things matters too. And so you're also figuring out, what kind of duration makes sense. So what's it look like to work with a firm like yours? What does that, look like as what's that process for the
Yeah.
advisor?
So I'll note there are of course other people who do what we're doing, but none of them are derivatives traders. Like there are people there who there are some clearly there's smart and talented people, and they some of them understand derivatives, but none of them are like come from the derivatives world. And like that was the unlock for me is when the way we started this is we were talking to RIA friends of ours who were showing us products saying, hey, what do you think about this? And we'd look at this and say, this doesn't make any sense. Why would you do this? And because if you dig deeper into the terms, um, a lot of these things, and I'm sure you have railed about this in the past, a lot of these things they hide complexity in the terms, and you need to understand derivatives to know where you're getting ripped off. And I cannot tell you how many times I'll look at a client's portfolio, and I mean we'll say it very nicely, but we're like like how did this end up in here? Like this doesn't make any sense. And so okay, so that's I'll get off my high horse too for a second. So like that's one of the things that makes working with us different is we'll flat out tell you, okay, so one thing, we're completely independent. Okay, a lot of the other big guys, they have um, they have really murky fee structure. They have conflicts because a lot of the issuers are either investors in their platforms or they have uh, they have preferential deals with a lot of these issuers. So like they're more incented to push product from a particular bank and not another one. We're totally independent. It doesn't matter if you trade with, you know, the tiniest bank in South America with us, or you trade with, Bank of America. It doesn't matter. We get paid the same amount. So that's one difference. And then what we'll do is we will sit down with you, the advisor. We'll figure out what it is that you're trying to do. Because typically, what happens is the advisor has something in their head that they're trying to accomplish, but they haven't sat down and figured out like, hey, what is my strategy around doing this? Like a lot of people use these things for income, right? For yield,
Mhm.
and a lot of advisors just say, okay, I want a high yield sleeve, and so that this is what I'm doing, and they have a strategy, but it's somewhat in their head and it's not systematized. We'll sit down with them and help tease out what is it that they're trying to do, and we'll just help you modify it. Like you talk about laddering, we do that all the time. We try to make sure that advisors aren't don't have a lot of note maturities at one time, so that if you do get a market downdraft, you're not exposed to lots of principal loss in a particular quarter or month. Um, and then a lot of times the advisors, they're not familiar with the some of the more efficient structures because they get confusing. So
Mhm.
like we've had advisors who we've had switch into different products they've never heard of because frankly they didn't even know they existed, and nobody's taken the time to sit down and explain this to them in ways they can understand, right? The banks issue all these like pricing statements and supplements and all that, but it's really confusing, and the advisor has much better things to do in their day than to sit there and look through the fine print on you know how the difference between a European and American knock-in option, right? So um so working with us, we'll sit there, we'll sit down with you, figure out exactly what it is you're trying to accomplish, and then we'll start giving you suggestions on, hey, this is what we think you should do. And then we have the platform and technology backend same as everyone else. So if you want to do portfolio analysis and all that table stake stuff, we have it. But it's really that kind of white glove service to figure out what it is you're trying to do and systematize that. That's where we're different.
You're taking me back. I'm flashing back to my days of studying for the Kaya and CFA and the seven when you're talking about American versus European options. Nobody talks about that anymore. We just say options like everybody, oh, it's a call option. No one ever it takes the time to be like, no, it's an American call option or it's a European call option, which is
Yeah.
actually an important piece of information that I almost forgot existed. So thank thank you for that.
Yeah.
But your point is a good one. Actually, everything you're saying is something that's true with Banríon, the independence, and not having the incentives misaligned and things of that nature. And I think that's really important in order for the advisor to be successful and understand that. You also talked a little bit about like it's all buried in the terms. I really do want to kind of hit that part home. When I talk to anybody, whether it's with any kind of ETF using a derivative contract or a buffer fund or a structured note, I really do encourage them to like read through the terms on the structures and the risks associated with it. Yes, there's a lot of legalese in here because the issuer is trying to cover their butt in case something goes wrong in the worst case scenario. But it's important to understand some of that nuance. And what are the things that you typically see in the term structure? Maybe some key terms or key aspects of the terms that you can kind of share with us so that the next time an advisor is doing this and considering it, they know what to look for.
Sure. So that's a tough one because it's like it's constantly changing. These the banks are, to their credit, they're coming up with new products all the time. Some of them are actually good products. Some of them are, in my opinion, not
You can
suited for
say it. They're
everyone.
terrible
Yeah,
products. Just go
yeah,
on.
and so you really have to take the other side and figure out, hey, why do these things exist? I'll give you a perfect example of one. So recently, the last few years, people have been showing, um, so growth notes are those are the notes that are tied to equities. So like you typically do that if you want S&P exposure or Nasdaq exposure or something like that. And so you get what's called upside participation. So it's like how much, if the S&P goes up over the course of the note, over the course of the note, how much of that upside you capture.
Mhm.
And you obviously want as much upside leverage as possible. And so let's just, for example, let's for argument's sake, say a 3-year uncapped note on the S&P has 110% upside participation. So what has started coming out is people doing notes on the SPXFP, which is the S&P futures exchange of the futures product. So now you're talking about an option on an option, right? Because the future being an option, which inherently gets more complicated. And with that, you can get, when the SPX has 110% upside participation, the SPXFP might have 180% participation. So a lot of people say, "Wow, this is like, why would I ever do the SPX? This one has way more upside." But what they don't realize is, now that you're trading a futures index, you're making an inherent bet on interest rates as well. So futures, without getting too complicated, like the futures have a roll. So like every few months, you're rolling to the new future, and those have embedded interest rates in them. So to trade SPX FP, again, I'm not saying you shouldn't do it, but you're not it's not just a bet on the S&P anymore. You're making a bet on the S&P and interest rates. And I cannot tell you how many people we've talked out of this, or at least like they were like, "Oh, thank you for explaining this to me because I thought this was a no-brainer. Like I got one where I get 180% upside and one where I'm getting 110. Why would I ever take the 110?" Well, that's because, you know, those are almost like, you need 180% upside to even be equivalent of the 110% upside, because you have this embedded interest cost and roll feature in it. So that's just a simple example. Yeah, kind of, it's almost like, we like to tell people, just anytime you see something that looks too good to be true, just send it to us, and we'll tell you, like, hey, again, we won't tell you not to do it. We'll just tell you, hey, these are the the things you should take into consideration, right? Because none of this stuff is risk free. Like I get this all the time, where I explain these products to people and they're like, "Oh my God, this sounds too good to be true." And I'm like, well, no, it has risks in it, right? Like you're taking on counterparty risk now. You're not just
Yep.
betting. You don't have the S&P. You're taking on. You're losing dividends. It's obviously less liquid, as you mentioned
Yep.
before. So it's our job to make sure that you're getting compensated for that risk. Like that's what this is all about.
I always like to remind people, if you think about what happened during the financial crisis and like who were hurt the most, right? Because a lot of that was fixed income and credit based, but like
Mhm.
the people who ended up the most hurt were the people that had the derivative on top of the derivative on top of the derivative. So you had your MBS, your mortgage backed securities, and then you had your CMOs, which are your collateralized mortgage backed obligations, which is like a derivative of the MBS. And then there were derivatives on top of that. And then you can trade derivatives on these products. And once you start getting further away from like the actual product that everything's being built on top of,
Yeah.
you are introducing a new layer of risk because now you have multiple counterparties and
Mhm.
multiple different risks associated with the new structure.
Mhm.
And I think that it's a good reminder that as you get further away from the underlying in the derivative structure, you are inherently bringing on more risks, and the risks become more and more opaque. And so you got to be really careful with that. You mentioned leverage, and I think this is an important conversation. I talked
Yeah.
about this recently on a show called ETF Battles that I participated as a judge. And we talked about leverage, and leverage means a lot of things, right? Leverage can be derivative induced leverage, which is using a derivative, to your point, to amplify the potential outcomes. But the risks associated with that kind of leverage are different than like the leverage of I have a portfolio of stocks. I am getting 8% off. I can borrow against that portfolio, and my rate on the borrowing is 2%, and then I can magnify the 8%. It's a different form of leverage, and it's a different risk profile. And there's, depending on the type of leverage you choose to use, you could be adding substantially more risk into the mix. When you talk about leverage and structured notes, can you talk a
Mhm.
little bit about the different flavors of leverage and like
Yeah.
how to address the different risks that come with those different flavors?
Yeah, I'm glad you read. Thanks for bringing that up. I because and I'm sometimes I shouldn't have used that word leverage because that implies what you're saying, like you're borrowing against something and you have, you know, way more capital at risk. So, well, yeah. So what I was referring to there um, is participation. You're talking about like how much the point of using options is to either reduce risk or to amplify gains. That's like in a nutshell, that is the point of options where you're amplifying gains where you have a limited downside, right? When you buy a call option, the most you can lose is the price of that you paid for that call option. So that's what I meant by leverage is like if you buy lots of call options, you have upside leverage, meaning if you buy a bunch of SPY call options, the market goes up, you make a lot more than what you put in. um but but you're still limited with your downside. So
Yeah,
when
but
I
the
when I
opposite's true
yeah,
too. If you're selling an option contract, then you have
sure.
unlimited downside. That is also leverage. And that's exactly the point I'm trying to make. Leverage is all different things, but in essence, you use leverage because you think you can get a better return than the cost of the leverage itself. But you have
Yes.
to understand, is your leverage capped downside or is it not capped? Is it capped upside? And you really need
Yeah.
to understand the underlying as it relates to that. Correct. And
for
and
for
these
for
structured
sure.
notes use all different forms of
They
leverage.
they do, but they also like they're not unlimited loss products. It's not like selling a naked call option, right?
Right.
Where you can theoretically lose infinity, right? And these you can only lose what you put into this to the structured product.
Mhm.
So it is different than listed options in that way. But yes, you're completely right that people truly need to understand uh what is their risk to the downside, and frankly the tax consequences of it too, because sometimes if you have a product that's fully principally protected, um, you have to pay phantom income tax on it over the course of the if you don't have capital at risk, then the IRS deems that hey you need to pay income tax every year on the incremental gains of that zero coupon bond, which is essentially
Oh,
what you're
yes.
getting. So again, not to get too in the weeds here, but that's another fun, complicated topic that that these things can bring in.
So, as we kind of come to the end of our time together, I would like for you to tell our audience if you are considering these types of products, whether it be a structured note through the calendar offerings or a custom offering or a buffer ETF or anything in the flavor of this. What are
Mhm.
the like 5 questions that they absolutely must ask when they're considering these products?
So the main question is the same question that advisors always have to ask with anything, was just suitability. Uh, these things are not for everyone, but specifically when it comes to these products, you should take a step back and think about what if it is something more, if it is a vanilla thing like just a something on the S&P, betting on the upside of the S&P. Those are pretty competitive, and those are pretty clear. You should definitely, to your point, make sure you understand the downsides, because the upside there are pretty simple, but sometimes people get confused with what the difference between a buffer and a barrier, and like you said, like we were saying, American and European. So definitely make sure you look at that. Um, the When these things start getting more complicated, when you start adding other indices, when you start putting in different calls, honestly, like you should talk to or ask the salesperson, whoever's talking this, whoever's mentioning this to you, ask them how they're analyzing the underlying makeup of the options, because these things they're all just, you know it's just a combination of options packaged together. And so they should know what are all the options that consist, that make up this particular note that they're pushing, and how those interact with each other. And that's the big question. And why. And so ask how they interact with each other, and then why this one makes sense over something more simple. Because what often happens is people hide, adverse terms in complexity. So when you
Mhm.
see things that are uh, you know sound a little like, when you have to start really thinking about, like, what are the payoff structures going to, like, you should immediately look at one of these things and understand the payoff structure of, like, the payoff graph in your head. If you have to start thinking about it, it's probably there's something going on where there's some added complexity that potentially doesn't need to be there. And almost always the added complexity favors the issuer and not
Mhm.
the advisor.
Yeah,
So,
I
like,
always say it's like the casino.
yeah.
I will add to that list of questions. I think a simple way to think about it is we do not work in a business that is a charity. These things are being issued for a reason because they are profitable and there's a profit opportunity here. So you want to
Mhm.
think about all the ways that the issuer is making money and all the ways that the structure could favor them over you, and what ultimately is the potential things that could go wrong on your end and how that would impact the client. I always like to say, for better or worse, and a lot of people don't like to think this way, you should always walk into these opportunities thinking about everything that could possibly go wrong, not everything that could possibly go right.
Mhm.
Even if the probability of the thing going wrong is low and the thing going right is high, you still want to understand what that looks like so you know what the worst case scenario would be from jump. And then decide if the best case scenario makes the worst case scenario worth the risk.
Completely agree. I'll just add one thing though, which is most of the time, almost all the time, the banks are not betting against you. We get this question all the time. They're like, "Hey, I have this S&P note from with Goldman Sachs. Goldman Sachs is really smart. Does this mean that they think S&P is going down?" no, the Goldman Sachs and all these banks, they view structured notes obviously as a profit opportunity for sure.
Hmm.
There's margin in them for them, but it's also it's the reason they love these things is it's a cheaper funding mechanism for them because
Right.
they have all this risk on in their trading books anyway. So what they're trying to do is they're trying to offset the risk they already have on, and then so like if they sell you China a note, an S&P note somewhere else in their book, they're long S&P. Now they sell you a note where you're long S&P, making them short S&P. So now they're flat S&P, and now all they've done is they've borrowed money from you. So it's a calculation of, is this money cheaper than if we went out and issued, short-term debt?
Right.
And so like so that is what's driving it. It's not necessarily that they have the opposite view of you. It's like they have this risk on somewhere else, and they're just viewing this as a funding mechanism.
Oh, I absolutely agree with you. I think a lot of people always are thinking like, "Oh, they're doing this to take advantage of me." No, not necessarily.
Not necessarily.
It's they definitely have a profit motive, and they're definitely doing it for a reason. Just understand what that reason is so
Yeah,
that you can understand the dynamic in the relationship. But it's never, oh, we think the S&P is going down, and so we want to bet against it, and we think you're stupid. More often than not, that's not the case, but there's definitely some sort of risk mitigation that's going on, some sort of trade-off that they're considering, that this is better for them from a profit motive. And ultimately it's all the same, right? As an advisor, you're choosing and selecting opportunities based on a profit motive yourself.
of
And
course.
so just everybody understanding and aligning, what the incentives are, I think is important. It doesn't make those incentives bad. That's what makes capitalism work, right? Everybody has a profit incentive. But it's definitely not as, seedy and undermining and evil as people sometimes like to make it think. The people creating these products are just like me and you. They have families. They go home and they're not looking to like hurt people, but they are looking to,
They're not in a lab somewhere in the
yeah,
dark trying
like
to,
with
yeah.
the evil, like Dr. Evil going on, like how can we ruin the world and for maximum gain. Yeah, so sometimes we talk about these things, and I think sometimes we do a disservice because we make it sound that way. But ultimately, all of us are aligning our interests in some way, shape, or form, and just understanding where the those incentives stand is like half the battle,
Mhm.
because everybody's doing it for a reason. And so I think that that's just an important thing to always be thinking about. But why don't you tell our audience where they can find you, and anything else that you think we missed?
No, I would just say that, hey, we're here to educate folks on structured notes. So these things, like we keep saying, have gotten a bad rap. I was one of those people for a long time, and I'm also not like a I'm not an evangelist. I'm not saying that these are for everyone and everyone should use it, but they are really powerful and they are really useful. Um, if anyone is interested in just learning more about them, shoot me an email, Vinay at marinelayeradvisors.com, or visit our website, marinelayeradvisors.com, and shoot us an email. We're happy to educate anyone on, you know, what these things are and how they could potentially be helpful. Even if you have no interest in the product, you just want to learn more about it. I just think it's a fascinating thing, and more often than not, we find that the more people get comfortable with it, the more they realize, oh, okay, this is not what I thought it was, and this might make sense. One thing I'll add that we didn't talk about, and is, you mentioned the negative connotations towards these things, and it's completely true. I mean, I can't tell you how many meetings I walk into and people are like, "No way in hell I'm ever using these things. I've never will. These things are evil." And by the end of it, they're like, "Oh, okay, maybe there's a use for it." There's a big kind of age gap between the folks who've been around longer typically have a more negative view of these things than the younger folks. The younger folks who've come up, after the financial crisis and all that, um, have a much more positive view and like tend to use these a lot more than some of the older ones. So like it's an interesting thing where you have a lot of the younger, newer advisors using these, and you have a lot of the older advisors, which also makes a lot of sense, right? If you were an RIA, has been around for 40 years, you never touched any of this stuff. You
Or
probably
you
talk to people,
did, or you did.
or you
I think
did,
it's
yeah,
more likely
yeah.
you did, because our industry is great at prepackaging the same thing that didn't work the first time in a different way for marketing purposes. And anybody, I remember I had a derivatives professor that presented at a CFA Society of Boston for me, Dr. Simon, may he rest in peace. And he talked a little bit about how structured notes and portfolio insurance of the 80s is they're just flavors of the same thing.
Mhm.
But it doesn't, but he was also a derivatives professor who, like you, understood the underlying trading and was a fan and a believer in derivatives. So he wasn't saying that these were bad, but I think to your point, the older generation has seen the different iterations of these things and is just increasingly more skeptical, whereas the younger generation hasn't quite been burned yet. But to your point, working with firms like yours can help the younger generation never have the experience the older generation did, because they can go in eyes wide open. And I think the eagerness of the younger generation to learn is something that is helpfully going to help them not repeat the same mistakes of the past.
Well, just with one thing that I'll also add is this reminds me of my career in the options trading market. Like I mentioned, my first job, I was on the floor. It sounds insane now, where we were trading in fractions. Like one of the big things we had to do is like learn fractions math really fast. Like that was like a big part of our job, which sounds crazy. Um, and now everything's electronic. Now everything's super efficient. Structured notes are like options in the early 2000s, and they're getting more efficient, they're getting more modernized, they're getting more accessible, and I just think it's a trend that's going to continue over the next 5 to 10 years, because I've seen this movie before, and it reminds me so much of the proliferation of listed options.
Yeah, absolutely. Well, thank you so much for your time. And thank you, everyone, for listening in to this episode of What's the Alternative? I am Shana Orczyk Sissel, founder and CEO of Banríon Capital Management. As always, don't forget to like and subscribe to this video and this podcast. Leave a review. Let us know how we're doing. And if you have an idea or a subject that you want to hear more about, please leave a comment and let us know. We want to hear from you. We will see you on the next episode.
The opinions expressed on the What's the Alternative podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or in any specific security. This is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this podcast is no guarantee of future results. The guests featured on this program are participants on Banríon Capital Management's platform. As such, Banríon may receive payment for their participation as a platform partner. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed investment professional. Investments are not FDIC insured, nor are they deposits of or guarantees by a bank or any other entity, so they may lose value. Investors should carefully consider investment objectives, risks, charges, and expenses. This and other important information is contained in the fund prospectus and summary prospectuses, which can be obtained from a financial professional and should be read carefully before investing. Statements attributed to an individual represent the opinions of that individual as of the date of the published podcast and do not necessarily reflect the opinions of Banríon Capital Management or its affiliates. This information is intended to provide educational value, highlight issues, and should not be considered advice, an endorsement, or a recommendation. All Banríon Capital trademarks mentioned are owned by Banríon Capital Management, Inc., an affiliated company, or its funds. All other company and product names mentioned are the property of their respective companies.